Trading options is very fun, very powerful. It's a great tool to have in your journey to reach financial independence and retire early. I've been trading options for a few years now. I've quadrupled my account using options, which is just awesome in just a few years. Now, the thing with options is that there's just so many things you can do with it that it can almost be overwhelming because there's so many things you can do with them. Even just a little quick Google search and coming up to this ally page here, you can see that there's a lot of different strategies you can use. And to be frank, you don't need to know how to do all of them. You really don't. Only got to figure out what works for you the best, learn a couple tools the best way that you can, master them, and then just stick to using those that make you profit and cut out everything that doesn't. I mean, that's how simple it is. In this video, I'm going to talk about my favorite option strategies that help me grow my portfolio, and that does include going over when to put these on, and then how to manage the positions. I think that's the thing that's really key for options, is learning how to manage the positions. Even if you're 95% of the time, you're going to be correct on stuff, that 5% that you're wrong can really hurt you if you don't know how to manage the positions. So knowing how to do that is a big key in being a successful trader, along with risk management. But this video is going to be talking about just a couple of option strategies that I love to use that have been doing good for me. And hopefully you learned something during this video. If so, leave a comment, like, share, because it does help this channel grow. And let's go ahead and jump right into it. One of my favorite option strategies is simply selling a put. It's very simple to execute, and I've had great success with it. There's many ways to manage the position if it goes against you. And ultimately, if you're okay with buying 100 shares of that stock at that price, then that's the worst case scenario. Then you just bought something that you wanted to buy anyway for your discount. And you got paid to do it also, which is pretty cool. So for selling a put, what I'd like to do is first look at the charts. It doesn't take too much time to look at a chart to come up with a trading thesis. Now I'm using Thinkorswim, and I'm using the on-demand feature so we can get some live prices. So we can actually simulate, like, putting on some of these trades, what you would actually get. And I try not to cheat. I think we know that AMD shoots up from here and then it shoots back down to like 105. But looking at the data we have now, I could see that there's a little volume here, so I might be comfortable selling a put at like 120. Basically, when you're selling a put, you're making a promise to buy 100 shares at that strike price if the price of the stock is below that by the date of execution, or the date of expiration. So what I'm basically trying to do is say, this is where I think the stock is not going to go, or this is where I'm okay with buying the shares at. Now, looking at the chart here, you can see a little volume here, so I would try to be below 120 if I can, depending on what the credit can be. Even the Fibonacci's show that it's going to take a while to get through that, hopefully. And we know that if things really do go south, it'll trade in a while when it gets back down to like 106 or 107, because all the volume that takes place in that time. So what I'm looking at is going to be looking to sell a put at 120. Lower might be better, but we'll kind of weigh how much premium we're getting on the risk that we're doing. So I'm going to go to the Analyze tab. And the bread and butter that I've been doing is selling like 31 days out, like 30 to 45 days out. Typically, I look at the monthly here. And we said I want to be below 122. And it looks like the premium there is actually pretty good. So what this means is that I would collect $2.57 for every share. Since an option is 100 shares, multiply this by 100. So $2.57 here is actually $257 of cash that they're going to pay me in the form of premium. And that's money that I keep no matter what happens in this trade. So I actually like this one because the delta, which is another thing I like to look at, is actually below 30, which is kind of my cutoff. Like if something's higher than 30 delta, then I need to go back to my charts and reevaluate, because the delta is just saying that this is very expensive. Some people only look at the delta and they'll say like, oh, 10 delta, that's what I'm selling. 15 delta, that's what I aim for. I like to use the chart first and then see, okay, well, what does the delta tell me in addition to what I already looked at? So here I'm going to go ahead and click sell. And you'll see it pop up in the bottom down here. And then we're going to go ahead and look at the risk profile to show you what that looks like. And change this to like the day after, just so we can get a decent graph here. Is that gonna take that? All right, so now we got the graph up, and you can see, like, if you sell a put, this is what the P&L looks like. And quite frankly, if it stays above 120, which was our strike price, we make max profit. We're looking at this blue line here. And the profit is going to be the premium that we got paid to put in. So like this is a position that you have a max defined profit. And that's what you got paid to enter this. So you can see the blue number down here is always at 257 if we're above 120. Now our break even is where this red line intercepts here. And basically what that is the strike price that we sold minus the premium that we got paid. And that would be our cost basis if we were actually have to buy the shares for 120. So that's how you figure out what that number is. And then after that, our loss is as though we own 100 shares of the stock, because we will own 100 shares of the stock at that point. So that's why you have that loss, that, you know, the diagonal line going down. Now, the worst case scenario is that you want to own these shares. You just bought these shares at a discount, because right now it was trading at what price? 137. And we're saying in 1 month we buy it for 120 or even less if you do the adjusted cost basis. So that's what this play looks like. And then over time, this pink line is just showing you the P&L of what happens if the price moves before that by this date. And you see that as we increase this, the pink line just kind of races to become the blue line. So in order to get an early profit, a bigger move will make that pink line move in the profit. And like you might be able to get out here and, you know, close it down for 50% profit if it moved to 130 by February 3rd. So that's just what the pink line is showing you, is what the estimated price would be based on the price of the stock on this date as you get closer and closer to expiration. So now, how would you manage this position? Well, I'm glad you asked that. One of the best things about options is that you have many options on what you can do to manage an option. So first off, one, you can actually just take the shares, and that's perfectly okay. And a lot of people do that. It's a great thing to start off with. That's actually one of the first steps of running the wheel strategy, which we'll talk about a little bit later here. Number two is you can roll this position. So let's go ahead and, you know, we'll fast forward a month over here. Let me switch that. We sold what, the 211? Good. Let that load. Oh, perfect. Looks like AMD does go down. Is this? All right, so right now, AMD shot down to 113. That means we are in the money. So now if we go to the option chain, we'll actually see that we're at a pretty big loss on this right now. And in order to close this position, it would cost about $7 to close. So I'm just going to go ahead and write that over here. So $7. We got paid, what was it, 240 or so? Let's just call it 250, just to make the math easy. So that means we're looking at a loss of 450. So we go ahead, and what we would do is we buy back to close this position, and then we can roll it out a month, and ideally it'd be for more than 450, which it will work like that because of extrinsic value. Switch that. So now if I go back out a month, or even just do 28 days, if we look at that same strike price, we're at 13, which means we are buying back the one for a $450 loss, but then we're selling the next one out for about $1,300, which is a pretty big net gain. And that's what I would do if I'm running the no assignment strategy while selling puts. And you see me talk about that all the time. I really love that method for managing these positions. And actually, it might help if I actually looked at the right one. So we'd be selling it for $12. I'm sorry, I was looking at the wrong strike price. But still, you can see that it's worth more. So you take a loss now to get more time to be right in this instance. Now, another thing you could consider doing is actually lowering this to whatever value you can get while still getting a credit. So if you really just want to be off the hook for this entire trade completely, that's what some people will do, and I've done that in the past as well. So I took a $450 loss on that last play. I can come over here and roll it down to, well, we'll even say 108 here, and still collect $100 for making this trade. And now we're back at almost 30 delta, not quite, but it's better than sitting at 60 delta, which has a 60% chance of still being in the money at the time of expiration. So you can slowly roll your stuff down to a lower strike price until you're finally out of the money, and then you collect that premium anyway, and you never had to buy the shares. So that's what's called rolling your options. And it's really nice to do because you can always do it for credit, simply because the extrinsic value of an option that's further out in time gives the option prices, the option contract, more value than the one that is closer to expiration. Now, if you didn't want to like roll down to get a better chance of getting out and you're sitting here at 120, the next question you might have is what would happen if somebody decided to actually exercise early? And the answer is you say, thank you. I've only been exercised early once, and that was on a dividend capture play. And the person actually gave me extra money than the dividend was worth, so that was awesome. But if someone did decide to exercise this early on you, you instantly get to keep all that extrinsic value that's in this contract. Turn around and you sell the shares at market, and then you just reopen the position. Like, they literally just gave you free money by exercising early. So people are afraid of being exercised early, and I'm like, no, please give it to me. Can I volunteer? So I don't think that's a big concern. The biggest concern that would happen would be if the stock continues to go down and you just can't roll it out in time because the strike price isn't there anymore. And that might be something that you might see on something that moves that moves a lot, like Tesla or Amazon. Like if Amazon starts trending down to like 2,500, well, those 4,000 strikes might kind of disappear over time. Or if you're doing it on SPY, we saw that on the SPY video where you have a hard time rolling to the same strike because they just simply aren't there as an option. So that's what selling a put is. And a brief look at some of the ways you can actually manage that position. So we talked about rolling the position, rolling it down to try to increase your chances of being correct again, which is always nice. Another thing that I've done as well is like I've done I like to call it the double down roll. And that's where instead of selling one contract to make up for it, I'll sell two. So in this example, we paid $450 loss to get out. And what I might look to do is sell two contracts that'll still let me a profit over that. So I'm taking on more risk in the fact that I'm now might be on the hook to buy 200 shares, but I can lower my percent chance to be right, or I can raise it to be right drastically by doing that. So I could sell all the way down to even here, but let's just go ahead and say the 100. I could sell two 100s. Actually, that's a lot. Let's do this one, 98. We could sell two 98 strikes in the future as part of our roll, collect a little over $500 here, which is still a $50 credit beyond this. And we just change our delta from 35 to 21. So now we have almost an 80% chance of it finishing out of the money and being off the hook completely. So that's another thing that is available to you if you're trading small with your puts. You can turn around and sell more contracts to lower your strike price if you really want to get out of the trade and just finish out of the money. Now, this would be something that you only do if you still believe in your initial trade thesis that the stock will go up, or at least it won't go down to this point in time. And I think in this case, it actually went up, so like all of these options would have been fine if you would have. Well, actually, March. Yeah, March 22nd it was above, I think. So all these would have expired out of the money. Uh, Again, the beauty of options is there's just so many ways to manage it. The next thing that I like would be the selling covered calls. So options, there's really only two things you can do is sell or buy calls or puts. But when you add all the strategies together, like you can make a lot of neat combinations. And it's very tempting to go crazy and do some complicated stuff. But usually I just like to say, like, find what works for you, do only those things, and you're fine success. Get really good at a couple of things is all you need to really do. Just gonna go ahead and go back in time here so we can, play around with the prices and stuff. So selling a covered call would be if you own 100 shares, you sell a call. And I'll throw that on as soon as we get this loaded. Okay. So gonna go ahead, exit all that. And it's been a while since I've actually bought shares in this analyze tab here. So I'm gonna buy 100 shares. So we own 100 shares. I'm just gonna type this in just so it stays static in case the price moves. So we bought 100 shares of AMD. We're happy with that. We think AMD is gonna go up, but we think it might hit resistance. It's gonna hit this volume this volume spike here where a lot of action takes place. So it might not get above 145. So I want to go ahead and make a little money in the event that it doesn't go above that. And if it does get to 145, I'm okay with taking that profit. So what I'd be looking to do is sell a cover call at 145, and we'll see what happens here. So going out a month, that's just what I'd like to do. 145, and you can see that this sells for almost $400. We'll go ahead and click sell. And so that's $400 that I just made. If AMD goes down, then my cost basis or my adjusted cost basis is 130 minus 385. So this cover call can kind of act as a hedge in case of a small move against us, which we know will happen since we just looked at the example on the put side. But if AMD did go up past 145, then we would have to sell our 100 shares for $145 each, which would be, what is that? $1,500 in profit from that alone. And we got $380 for selling this call. That's the beauty of selling the cover call. It's very passive. You can choose how far out you go in time, as well as what delta you want to go through. So how likely you are to actually lose these shares. I use the chart to base my my price point at. Some people just look at the deltas. If you're a dividend stockholder and you really just want to collect a little extra premium, but you don't really want to lose your shares, you might just look at delta, go up, and do 5 delta or below. That means 95% of the time, your call is not even going to get challenged, assuming that the percents here play out. And that's saying AMD goes to 180. Well, if AMD went to 180, you might want to take those profits anyway. So that's what you can do to adjust. You get less money when you do it further out of the money, but it's safer. You're less likely to get challenged, although not impossible. Stuff does happen. Just look at GameStop and Tesla. But that's another way to make extra income off your dividend stocks if you're holding 100 shares of a company. And then you can take this $47 and go out and buy another share of a stock that pays a dividend. So you could use it to just keep compounding your growth. It's pretty cool. Let's go ahead and look at the risk profile. And you can see we kind of have a similar thing here. And that's because we're collecting a credit off the cover call. And the reason why it flatlines here is because this is where we have to sell our shares. So 145 gets breached, we sell the shares, we're at max profit. So we make a total of, if you look at the blue thing over there, $847 for doing this entire trade. Now this does involve buying 100 shares of this first, but that's still a pretty nice return, I think. 2,000 out of 13,000. Was that 10% almost? So the beauty of the cover call is it gave us an extra $380 for taking a profit as well. So if you have 100 shares of a stock, learn about selling covered calls, see if it fits your profile. Now, when managing the covered call, For one, I like having a no assignment strategy, so I'd probably just let the stock go. I would call it a win and move on to the next trade, sell a put on something else. Or even if you like AMD, I would turn around and sell a put on AMD, kind of run the wheel strategy a little bit, and try to buy the shares back for cheaper than I just got them. And if not, I'll just keep collecting that premium from selling the put. So if I was breached on the cover call, majority of the time, I'm just letting it go, taking that profit. But if you're like a dividend investor and you want to keep that stock, maybe you want to avoid like some short-term capital gains as a result of selling your shares, because maybe that's coming up on the 1 year thing, you can always go turn around and just roll your call out in time. So it's very similar to what we just did. We sold this on 211, so we're going to jump to 211. Go back here. I guess I probably should have taken a different stock because we knew that AMD was actually going to go down. So we don't have to roll this position. Uh, but I guess we can still show you that going out a month in time is worth more. We see that the 145 is worth nothing, so like it'll take 1 cent to close. But again, if you go out like 30 days in time, it's worth more than 1 cent, even though the stock is down. So we can still roll this for a 67-cent credit. Basically, we just close down the call we have on now and uh, sell the new one for another $67. If it was in the money, similar to the put, you would just buy back for a loss, go out a month, sell the same strike for a net credit, so you're making income off making this trade. Or if you want to, similar to what we did with the put, you can go further out in strike price and sell a further out of the money call. And when you're doing that, you're also getting the profit if the stock moves up on the shares themselves. So you would no longer be capped at 145. Maybe you'd be capped at 155. That's an extra $1,000 of profit from the shares of the stock, in addition to whatever you rolled from doing the call for a credit. The main key is when you're doing a roll is that you roll for a credit, and then eventually if the stock does move in your direction, if you still believe in it and it does do that, you're just saying, I want more time to be right. That's what rolling is all about, is giving yourself more time to be right. And while doing that, you're getting paid to sit there and just kind of wait it out. Theta is awesome. And it's what helped me grow my account from 64,000 to a little over 200,000, was primarily using theta strategies, maybe a little bit of luck with Vega, but majority of my strategies are based around theta. The next thing I want to talk about is selling a call spread. And we'll go ahead and go back to the chart. And just like everything else, when you're selling a call, if you don't own the shares, it would be a naked call. And I've been trading options for a few years now, and I still don't sell naked calls. I know how to manage them if stuff goes wrong, but if a stock has the potential to go to infinity and it actually does happen, or like, some kind of squeeze Wall Street bets thing happens, I don't want to be on the hook. I always want to have like a defined max loss. Like if I blew my account up, I don't want to owe money in addition to what I had in the portfolio. You know what I mean? So one way to do that, if you don't want to buy the shares, is to turn it into a spread. And what that means is you're selling a call, and then you're going further out of the money, and you're buying a call. And what that's doing is making you have a max loss of what could happen. So we'll go ahead and just do this. Close these out. And I'm not even going to look at the chart for this one, for this example. What we're just going to do is just look at this. Actually, first, let's actually look at the chart. So if I was going to sell a call spread on something, I'm trying to predict where the stock will not go. And what I like to do is see, like, it has a long distance to go back up to, like, some high in the last 2 years. Let's change this to the 2-year one day. And you can see, well, obviously, the high is here. So let's go ahead and zoom back in here. So I would probably want to be, like, above here altogether, so that if it does reach all-time highs again, I'm still not being tested. Although looking at all these spikes here, like, it's got a hard time to get back up there, it looks like. It's going to have a lot of volume to push back up there. But for this example, we're just going to show you pretty much, we're just do at the money just for an example. So here we'll just sell the 114, and we'll have to look at the mid price here. So that'd be 780. Type that in. And then we go further out of the money, and in this case, I'll just go $1 up, so 115. We'll buy this guy, and we can see that the mid price, we'll call that 720. Fine, we'll do 720. 720. Okay. Now we're just gonna go ahead and look at the risk profile here, and this is what the graph looks like now. And basically, your gain and your loss are both capped. Your max profit is going to be if the stock. Sorry about that. Just had a. Okay, brain freeze. Okay. Your max profit is going to be the credit you receive to enter the trade. And in this case, $60, 780 minus 20. And you can see down here, max gain, $60. Your max loss is going to be the difference between the two strike prices. So we have 114 and 115, so that's $100 minus the credit you received, which was 60. So that gives you the 40. So your max gain is 60, your max loss is 40. If AMD moves below your short call, you make max profit. If it stays above max, if it goes above your long call, then you hit max loss, but you're not on the hook for all the losses that would happen if you didn't have that on. I'll show you what that looks like without that. So if it moved above 115, looking at that blue line here, you can just see it just keeps going down, down, down. And those losses are infinite. So if AMD had some kind of news and went crazy, I mean, you can see the losses pile up really quickly. But by buying that protection, your max loss is defined at $40. That's awesome. So basically, you're risking $40 here to make 60, a little bit over 100% return. Now, don't go crazy and do like 1,000 contracts. Like, oh, I could double my money. If you're gonna be using call spreads and put spreads like this, spread them out on other tickers so that one stock moving against you doesn't kill you. You know, spread that risk out by placing a lot of bets out there, essentially. So don't just do 1,000 contracts. Because, yeah, you get bigger gains and bigger losses. But again, you'll put it all on one play, which is, you know, kind of crazy. Now, I'll be honest, I don't have much experience managing the call spreads. I'll typically look for like 50% profit, close it out, and move on to the next trade. If it goes against me, I was fine with losing the $40 on this play. Obviously, I was wrong on the direction of the stock. I'm not going to try to defend it. And rolling multiple legs of contracts sometimes can be harder to do because the fills might not be that great. But some interesting things you can do with this is, let's say that that AMD gets some news and they're starting to move up, and you change your mind on which direction you think it's going to go. What you can do is you can close the short call that you had for a small loss, and now you can ride this call up, and the profit that makes, if it keeps going up, can make up for the loss that you had and then some. So you do have the power to adjust just one part of this play in order to change the entire P&L in your favor. If there's new news that came out that changes your thesis on the original trade. So this is a call spread. Now, when you're doing this, you do give up obviously profit potential. So in this example, we went from getting $735, or actually, sorry, the prices have been changing drastically here. We gave up the chance to make $780 to only make $60 because we bought that insurance. And some people just see that as an expense. I see that as a necessary tool. Like, if stuff goes wrong, I don't want to be on the hook for owing tens of thousands of dollars because the stock mooned, you know. Another thing you could do is, instead of doing multiple combinations of this I'm sorry, I'm tongue-tied here. a multiple lot of this contract, instead of doing the 115, you could go ahead and say, I'm fine with risking $1,000 on this play, and I want to get a little bit more premium for doing that. So what you can do instead is sell or buy the call that's 10 away. So 114, 124, buy this. We're calling it 370. Actually, yeah. Oh, yeah. And actually, let's just call it 380 just to make the numbers easy. Why not? 380. So instead, now we're risking $1,000 or a little bit less than that to make $400, which is the difference between these. If we look at the risk of the P&L here, you can see max gain here is 400. That's the difference between, that's the difference between what we got for when we sold the call and what we paid to buy the insurance. So that's the $400. Our max loss is going to be the $1,000 minus the premium received. So we should be looking at 600. And you can see our max loss is in fact 600. So the difference between the strike prices minus the premium that you receive when you sell the call spread. And the beauty of this is that theta is working in your favor as well. So if the stock moves down, or if it just stays where it is, you're making profit from just theta eating away, because there's a lot of extrinsic value in that. And as long as it stays out of the money, you make full profit. On the flip side, if you think a stock's going to go up, or at least just not go down, you can sell a put spread. It's basically the same thing. Where do you think the stock's not going to go? Let's just say 100. And let's say I'm afraid that, I could be wrong. I'm a new trader. Maybe I should buy some insurance. And I want to just, buy something out here just in case just goes completely against me. I'm always fine with buying insurance and using spreads as kind of like an insurance thing. I assume that this contract is going to expire worthless. This $140 that we're spending here is not going to come back to me from this particular leg of the contract. This is just insurance, peace of mind for me. And I would never not put on like an insurance call just because it decreases my overall P&L, especially to the call side. So on this, it's the same thing, except now the stock stays above our short strike. We make max profit. Our break even is someplace in between. Our max loss is the difference between the strike prices, 1,000, minus the credit received, which, what is that, almost 160. So that's how you get to 838. And that's what the spreads look like if you're selling credit spreads. The other thing you can do that I haven't really done too much is you can flip it. If you think a stock's going to move in your favor, you can turn around and buy the closest one or buy one and then sell one over here. And this is kind of a flip play. Theta's working against you. But now, if the stock moves in your favor, you make more money, and you still limit your max loss by the debit in this case. So if you buy closer and sell further out, it's a debit spread. Now, I don't use those too often. I mostly sell credit spreads. I like theta working in my favor. Although a debit spread might be something if you feel more confident that it's going to go in your favor. You can do that, especially if IV is low. It's not near earnings. It might be cheaper to go the debit red sprout. Or, I mean, it's not going to be cheaper. You're playing a debit, but if the potential for IV increases could help you on a debit spread, whereas volatility decrease helps you on a credit spread. Another thing that I do like, although I have not done too often, are iron condors. So if selling a covered call spread, if selling a call credit spread and selling a put credit spread made sense to you, you could turn around and get the best of both worlds and sell both. So in this example, same thing. You try to figure out, where do you think it's not going to go up? Where do you think it's not going to go to the downside? Sell both spreads. So analyze trades. What might this look like? Let's say I think 105 is safe on the put side. I can sell that. I'll just go 5 out, buy this guy. Let's say I think 120 is safe. We'll sell that one, buy this guy. Risk profile. And you can see now what happens is, if the stock stays between both short strikes, you hit max profit, and it's 275. And it's because you keep the premium that you received for both of these now. And if it goes against one of these trades, then your break even to the downside or upside is a little further out because you collect full credit for the other side of the trade. So if the stock was going down, the puts would be going against you, but the calls you'd be getting max profit. So that helps you overall in terms of like the break even price to the downside. And if the stock moves up and down like this, like crazy, if it moves up, you can just close out the call side. Or sorry, if it moves up, you could close out the put side and lock in that gain. And then when it goes down, you close the call side. So you can still use it to help time the market if you're willing to adjust your strike prices. A lot of people in the Discord, like James, for example, use iron condors in an amazing way to just print profits like crazy. But before you start using iron condors, you need to understand how to do a sell a put credit spread and sell a call credit spread. Once you understand those two, congratulations, you already know how to do the iron condor. Next up, the PMCC. This is a strategy that has made me quite a bit of money over the time. And it never quite works out the way I think it would when I put these on, especially when I was trading them heavily. So a poor man's covered call is when you use an option to secure the position instead of owning 100 shares. And why do you do that is because it costs a lot less to do. Now, typically, when I ran the PMCCs, I'll go out to the furthest leap that I can get. Some people use shorter dated PMCCs, like they'll buy a 6-month contract and then sell a closer to the money one on the other end. But so let's go ahead and just go do this one. So when I'm looking at my PMCCs, and this would be when I think a stock is going to go up over time. This is a bullish position when you're doing it with calls. I look for something that's deep and that has a high delta, like 0.9 delta, and I would buy this guy. So this would cost me about $6,500. We'll call this 65 to get in. And that's a lot cheaper than buying 100 shares of the stock. And can even use that to leverage up here. So instead of buying 100 shares of the stock, I could even buy 2 leaps. Why not? So that's the first part of the position is instead of buying the shares, you're buying a call contract. And that's because if your short call gets breached and you owe 100 shares, what you can turn around and do is exercise these, although we'll tell you a more optimal way to get out of this because you don't want to just exercise this to sell those shares, but we'll get to that in a second. The second part of this trade is that you are selling a call spread or a call against this, and it's a covered call because you own the leaps. Now, what I'm doing here is I'm looking at adding these two numbers together. So we'll call that 120. Yeah. Wait. Yeah. So I can sell a call this close to the money. That's crazy. Why didn't I do this one before? Basically, the goal is to sell covered calls to reduce your cost basis and just collect money over time. So this just becomes an income-generating asset. Looks like you could sell this at like 120 here and come away with a profit if the trade goes against you. But we're gonna go ahead and just sell a little further out of the money. We'll just do 130. I don't know. We'll sell 2 of these because we own 2 of those. So instead of buying 100 shares and selling a covered call at 130, for that same amount of capital, we bought 2 leaps, which means we can now sell 2 covered calls and double up our income for making that trade. The risk profile. Thinkorswim gets a little crazy when you start using different calendar dates on your spread sometimes. So it's not the easiest thing to look at when you're looking at stuff, but basically it's what you already talked about. So you sell a covered call, you manage that the same way that you would a covered call, except now you have leaps to do as well. If the strike price of the short call gets breached, so in this case 130, what I would do would be to close down the entire position unless I really want to be long the leap still. So I'd buy to close these for a loss, and then I'd sell to close the leap calls for a gain. And the reason why this works is because as the short call loses value beyond this point here, your leaps are still gaining value that offset that. So you still get that theta win, but at the same time, your leaps gain value all the way up until like the 130, and then just kind of runs a little flat beyond that. So you hit max profit if AMD goes to 130. Doesn't matter if it goes to 3,000. Your max profit hit at 130. So I would close out the entire position, buy to close the short, sell to close the leaps, call it a win, move on to the next trade. If you still want to be long the leaps, or if you just simply rebuy them to re-enter the position, what you would do is just roll the call, which we already talked about, buy to close the current one for a loss, sell to open another one in the future for a credit. You can move the strike price up so that you make more money on the leaps if it continues going up, or you can keep the same strike price. So something that people are afraid of is what would happen if the short call got exercised early and then you were short 100 shares. Now, you should check with your brokerage to see exactly how they handle it. I believe most will handle it the same way, although I can't guarantee that because I don't know every brokerage. So call your brokerage and ask them this question. But with interactive brokers, what would happen is you'd see a position that says negative 100 shares of that position or that stock, and you still have your leaps. Now, the first thing you think of is, okay, then I just exercise my leaps and it satisfies that. But you don't want to do that, because if you do that, all the extrinsic value of this leap, which is quite a bit, if we go ahead and go back over here, we bought the 55. So $750, we're just taking a lighter and burning it. So if you exercise your leap, you're giving up that value. So like I said before, when someone exercised early and put me some shares, like it's the same thing here, but now you're the one giving away that extrinsic value. What you would do, and you would do it in a combination order or a rollover order, is you would buy the closest expiration date of the same strike price, so 55, for 5,800, and in the same order, you'd sell to close your leap that you have, and then the difference between those stays in your pocket. So you still have that long call that you can exercise to satisfy those shares, but you didn't give up all that extra value. So just keep that in mind. If you don't get to close on your position by just using buy to close on your short and sell to close on your long, and you got put shares, roll your leap to the nearest expiration, and I'd even wait until this is 0 DTEs to do it too, because why not? Why leave any extra theta on there than we need to? And then I would exercise that call, or even let it finish in the money and exercise automatically. And then you see those negative 100 shares just disappear completely. Next up is the Zebra. This is a strategy I've been using for about 8 months now, and I really like it. And I've also been using it kind of like a tool to scalp trade, which is probably not recommended. But the Zebra is simply a combination of put or call orders, so it's a ratio spread. And what it's looking to do is capture like a large move in the stock price, as though you own or shorting 100 shares, but it has a max defined loss, and you do have some ability to manage the position. And it's really quite simple to put on, but like this trade is not a theta trade, so theta is not working for you. It's also not working against you because it's called a Zebra because it's a zero extrinsic back ratio. I'm not sure what the A stands for, maybe because it's awesome. And what that just basically means is there's no extrinsic value for theta to burn. And I guess we're just going to go ahead and show you what it looks like here. Typically, it is recommended to do this at like 45 days out or so. The further out in time you go, the more capital it takes to secure the position. But I'll talk about why you go that far out. What you need to do is pick a direction that you think the stock will go. If you think it's going to go down, you're going to be doing it with puts. If you think the stock's going to go up, you do the same thing with calls. And basically what you do is you sell an at-the-money call or put. I'm going to say that the stock's going down. Look at the extrinsic value, in this case 8.5, and you got to buy two deep in the money puts that add up to be about that. So this is 8.6. We're looking for 4.3. I'd probably go here. I'd like to use more money to secure their position and have less theta. If you buy this guy, you have a little bit of theta you have to worry about, but it's not significant. So I'm going to be buying this one. Gonna throw these up, and we're just gonna lock in these prices just so they don't change on us while we're looking at stuff. Luckily, the spreads here are pretty small. So this is what the play will look like. You can put this all in one order, so you know you get filled in all three at the same time. And then we look at the risk profile, and the beauty of this guy. This is February 11th. Go ahead and move this guy to February 12th. We'll say 1 day passes. The beauty of this is any movement in your favor. Why can I zoom in? Fighting me here. I think it's because of my because I got my iPad using this as well. Any movement in our favor, a $1 movement, equals a $100 gain in our pocket. And that's, if you look at the pink line, that's true of the pink line as well. So tomorrow, if it moves $1 in our favor, we make $100. Over here, if you watch like the pink and blue lines here, you see that they do differ. But especially if you go to the downside, if it's moving against us, although at expiration, which is the blue line, we're losing a lot more money. The pink line is showing that we're not losing that much because of the way that the deltas work. You lose slowly if it moves against you, as long as there's still time left on the contract. And what's great about that is if it does move against you and you still believe it's going to go down, you can close this guy down, reposition it, and then a $1 movement in your favor gets you $100 again. And just basically you're fixing your deltas over time. But a move against you, you don't lose as much. Had you shorted 100 shares, you would lose according to where the blue line is. So you lose slower, so it's a little bit less risky. But if you're completely wrong and the stock moons, you're not going to owe a lot as though you were short 100 shares. Your max loss would be defined by the debit you paid to enter the position, which is really nice. Can I just add it here? Is that going to let me do that there? That seemed like trade. Bye. But you can see, like, if I shorted 100 shares, like, my max loss just keeps going up indefinitely. And, you know, could lose the house. But with this guy, our max loss, no matter how wrong we are, is what we paid to get in. Although, we'd have plenty of time to get out of the position if it's moving against us. So even if we hit that point of where it'd be max loss early, we only lose a fraction of what we could lose by the max loss if we manage it. So over time, that pink line is going to slowly become the blue line. And you can see, like, it takes a long time before it really jumps down here. So you could be sitting beyond max loss and still get out without hitting max loss. As long as you manage it before you get to expiration, you can still keep a little bit. And then finally, when you get to the end, you know, it becomes the blue line. Now, what people tend to do is they'll match position with like 14 days to go, simply because it avoids that like pink line meeting the blue line. So 14 days to go, you close out the position no matter what happens, and then you can put out a new one if you want to. It's kind of the idea. It avoids Vega spikes, and you don't have to worry about time on this because there's no intrinsic value for theta to burn. So this is just awesome. Don't short 100 shares. Use a zebra. Like, it's really easy. You can also use these to run a PMCC. And we'll go ahead and just throw a little PM or a bold version of this on. So sell this guy. Look at the extrinsic value, 910. So we're looking at 450-ish. Well, I guess we'll go 3 here. Like, the goal is that you want to get these to be equal to 0. If this times 2 is less than this, then theta is ever so slightly in your favor, but it's not going to be noticeable. If you pay a little debit to get in or a little extra to get in, I mean, theta is going to be very minimal with this position. So it doesn't have to be exact, just close to zero as you can get. So here's the bold version of the zebra. We want the stock to go up. Any $1 movement in our favor, we make $100. Now the beauty of this guy is you could turn around and sell covered calls against it, and that's just another cool thing you can do. Your break-even price for the short call you can sell and still make a profit if you get breached is actually lower because you make $100 a profit as it moves up, rather than if you bought a leap, it'll take a little bit longer. So you have to get a little further out of the money to make that same scenario. So some people use these to run the PMCC strategy instead of buying leaps. They set up a leap zebra, and they can sell calls closer to the money as a result and collect more income closer. But this is more of an advanced strategy. If you're not used to all the other strategies I've already talked about, like, don't just go in and start doing this one. The zebras, you have to be right on direction. And if you watch my journey so far, you've seen I've been wrong a couple times. I've taken losses. I've tried to double down on the zebras and, compounded those losses, even though there's a max to define loss. If you add more contracts, I mean, you add more risk. I hope you guys found this video helpful. And if you have any ideas for videos in the future or stuff you want to see, go ahead, leave a comment below. I'd love to see what you guys want to learn about. And if I don't know how to do it, I'll learn it myself. And one of my philosophies is if you could teach us something, then that means you mastered it. So that's why I love showing it on YouTube and seeing you guys try to find holes in my stuff. There's been a couple times I've learned I was doing something wrong and through the comments and redefine my strategies as a result. It's made me a better trader. So feel free, come at me. If I made a mistake saying anything in here, just let me know about it. Hope you guys had a good weekend and good luck in April. And we're all excited to see what happens. See you next time.